This chart shows the valuation trajectory of Turkey's state liquor monopoly after its 2004 privatization. The government sold the entire unit to a local consortium for $292 million. 7 years later, the exact same asset was sold to the British beverage company Diageo for $2.1 billion. To see how quickly that value materialized, we have to look at the intermediate step. Barely 2 years after the initial purchase, the local buyers flipped 90% of the company to a U.S. private equity firm, Texas Pacific Group, for $810 million. The Turkish government sold the asset for a fraction of its eventual price because they measured the wrong things. Their 2004 valuation only calculated the worth of the physical production facilities, the 17 factories, and their tangible inventory. They completely ignored the massive financial weight of the brand's loyalty and its sweeping geographic distribution network. Diageo was pricing a dominant national platform. By acquiring Tekel, they secured an immediate, turnkey gateway into the country's consumption habits. This nearly $2 billion discrepancy was a systemic trap. The state lost out because they lacked the financial methodology to measure and price intangible global market value. Today, dozens of massive private Turkish companies are caught in that exact same trap. These are original equipment manufacturers, third-party factories that produce parts for other companies and products. They have enormous, proven production floors and quietly dominate their local markets, yet they remain completely invisible to global capital. Many of these are mature, family-owned operations spanning advanced textiles, chemicals, and electronics. They already generate heavy export revenue, but because they operate as unbranded suppliers, they lack global recognition. Their rigid corporate structures leave them chronically undervalued. They possess the physical scale of multinational corporations, but they are waiting for international stock markets to accurately price them. VMM Capital engineered the TAP-I fund specifically to rescue these companies from this local valuation trap. It is a strictly 36-month mechanism designed to restructure these firms and list them on major global exchanges like the NYSE, NASDAQ, or HKEX. Capturing this latent value requires a specialized bridge, a way to translate local operational power into the regulatory and financial language of Wall Street. The traditional private equity model fails these specific companies. Standard PE demands total operational control, replacing the very local expertise that built the massive asset in the first place. TAP-I approaches this differently, utilizing what they call the cruise captain or pilot model. When a massive cargo ship enters dangerous, complex international waters, the original captain doesn't hand over the wheel. Instead, a specialized pilot comes aboard solely to navigate the local shoals, currents, and hazards. TAP-I acts as that pilot. They board the company strictly to manage the regulatory hurdles, fill compliance gaps, and time the complex cycles of Wall Street initial public offerings. This structure protects the core asset. It leaves operational control exactly where it belongs, in the hands of the proven local founders, while adding world-class navigation for the global markets. This diagram represents TAP-I's structural architecture, known as EMS. Taking a massive manufacturing asset global requires an engine built on complementary strengths, rather than relying on massive upfront cash injections. The first corner is the local network. This entity sources the asset on the ground and drives the internal corporate governance reform required to prepare a family-owned business for strict public scrutiny. The second corner is the global capital channel. This node structures the actual IPO, manages the Wall Street relationships, and secures access to institutional investors. The third corner is the operational partner, connecting the local factory to international supply chains and technology integrations, optimizing the business for a compelling global narrative. This model operates on forced interdependence. None of these three corners can successfully take the company public without the highly specific expertise of the other two. By relying on structural teamwork as its primary tool, the MSA model ensures that capital is only applied after immense collaborative value has already been engineered. This transformation operates on a strict 36-month timeline, divided into two distinct phases. Phase 1 is the migration, 12 months of deep due diligence, reforming the family structure, and upgrading accounting systems. Phase 2 is the listing. This covers exchange selection and global investor roadshows, culminating in the IPO. This rigid playbook takes chaotic, local potential and processes it into a globally compliant, highly predictable asset ready for institutional buyers. We can look back at the 2004 Tekel story to see exactly what is at stake. The original Turkish state missed out on a 619% valuation multiplier simply because they sold prematurely, without the tools to price their own market share. By taking an industrial manufacturer directly to the global public market, TAPI ensures that the original local founders capture that massive valuation multiplier for themselves. In modern finance today, the sheer quality of a physical product is rarely enough to maximize its worth. The global market must be able to securely verify and access the corporate structure behind it. Global capital is abundant, but the pathways to it are incredibly narrow. With the pilot's guidance and the NYSE engine, the world's hidden industrial champions finally have the mechanism to realize their true multi-billion-dollar price tag.